My name is Ian Walsh, and this is Masters of the Market. We've been with Chris Haddon all week, my business partner. Chris, how's it going?
Going great. Thanks for having me on.
Good, man. So just so everybody knows, Chris and I don't wear the same shirt every single day. This is actually all being done in the same day. So I've actually had my brother ask me one time, he said, "Are you wearing the same shirt every day?" I said, "No, I'm not Mark Zuckerberg yet, okay? So give me a break." So, so today we're talking about with Chris here. You know, Chris's function in this business, which a lot of people don't know. Chris is the man behind the scenes that really runs point and is the cornerstone to making the money flow, right? Because we sell money, that's what we do. And myself, and Jason, we deploy it. But people, where does it come from? How does it get managed? Is there infrastructure? How are you doing that many loans? Here's Chris Haddon. Here's the guy that does it all. So, Chris, can you kind of let everybody know where you guys started, you and Jason originally, and how this grew into the way the partnership is divided or division, and how that's transpired?
Yeah, sure. Happy to. So Jason and I, we're friends from high school. We've known each other since, playing soccer back in the day. And after we went away to college, different places, ended up back in town here in DC metro area, we started getting involved in real estate, lending, like mortgage lending type stuff. Jason was a real estate agent for a bit. And then we started doing some deals together, rentals, a couple flips. And we were trying to decide what kind of business model, what kind of company was the right one for us, because we knew we wanted to run our own show, be self-employed, that whole thing. And we ended up, after hooking up with another partner, a silent partner in our business, landed on the hard money. I would say, like, we're better at the finance world, underwriting, marketing, that stuff, than we are hands-on construction. So that's what made the finance side of real estate better than the full-time acquisition. I mean, we do acquire properties, of course. We do a few flips a year. We have 18, 19 rentals. But definitely what we're best at is everything that goes into building a lending company. Now, mind you, when we started, it wasn't the easiest time. It was right after everything crashed. So we closed our first loan at the end of 2007. So we're coming up on 10 years now. And real estate was at the bottom. It had just totally crashed. And we were in our 20s, no track record really. And we were trying to raise millions of dollars. And it was very challenging at that time. Of course, it's come along since and grown nicely. But yeah, at the time, we didn't have a track record. The sentiment around real estate was really, really bad. I mean, people just lost all kinds of money. And we were like, hey, invest with us. It'll be great. Promise.
Sure.
So it was tough at first. And we started with just a couple people, friends and family, a couple business associates, very few people who knew enough about what we were doing. And then other people who were like, okay, I just trust that you guys know what you're doing. We started doing a couple loans, and that's how HMB started.
Okay, so interesting background. So you got in when the world was ending and said, jump into real estate with us, even though it's a four-letter word. I remember at that time, everybody wanted to be away from it. They didn't want to be in the stock market. They didn't want to be in real estate. Those were the two you couldn't be in, right? And you guys said, all right, let's start a business in this quote-unquote difficult time, when in reality, looking back, you guys started a business at the bottom of a cycle, which is, looking back, it looks genius. Not saying it wasn't genius, but, you look back and say, that's effectively what you did. So that brings us to today. We're in a totally different market space in terms of totally different sentiment to where we were 10 years ago. Where do you think we are now? Where are we going? What insight can you give us there?
Okay, so we are near the top of a market, in my opinion, and in many people's opinions, both real estate market and stock market. So stock market's on what, like an 8-year bull run, second longest in history. Is that right?
Straight uphill. Yeah, straight uphill.
Yeah. And real estate as well. Now, it's not as bad as 05, 06. It's not as crazy. Like we saw it during that time, and like the price escalations and what the finance world was like, it was much worse. Okay, but still, I don't think we're headed towards a crash. I think we're headed towards a correction in a year, maybe two. Like there's capital in the real estate market, and hard money in particular, that we've never seen before. Wall Street, private equity, institutional money jumping into our little like niche mom and pop thing, which it has always been, which just goes to show you it's the flavor of the month. It's hot right now, and that the people behind that kind of money, they're very smart. They know what they're doing. They know how to manage risks. They know how to look at markets. And I think they're jumping in while it's good, And then when a correction's coming in a year, maybe two, they'll jump onto another kind of asset class. But that's what we're seeing from the capital side, and as a lender and competition, price compression, everything else, that leads us to believe we're headed towards a correction.
Right, because you can only squeeze so much on either side, and then you're saying something's got to give, right? Something has to give. So, so that's interesting. So, what do you feel? I mean, I know a lot of this because you and I and Jason have conversations about this, but elaborate to everybody. How do you adjust if you're an investor, whether you're lending or whether you're flipping? How do you adjust to what's coming, and what are you doing now to prepare?
Yeah, that's a good question, because you don't just close up shop and go hide under your bed and like don't do any deals. Like, that's not an option. You got to keep your company running, but in the right way. So what we did about a year ago is we tightened up a little bit, maybe a little 5%, maybe 10% tightening of the screws on our underwriting of borrowers and underwriting of collateral. And during that time, the portfolio it was clean all along. Now it's gotten really clean. So we're in a good spot to take a little hit to the market for values to drop a little bit. We're okay. We're very tight on what's going on. So in terms of people buying properties, either buy and hold or flips, I would recommend the same thing, however it applies to your niche. So if you're talking about in terms of rental properties, you should be pretty good. Don't have crazy leverage. Have a good amount of cash. At the end of the year, you might take a good sized distribution or maybe pay down your loans or whatever. Maybe keep some more liquid than you normally would. Take a little bit less out yourself. That's one thing you can do. Over on the side of people buying and selling, I mean, mainly I would be conservative on the purchase price. You know how it goes. Like, people start escalating prices up. There's a lot of competition out there, and people are paying, maybe it's okay, with markets with the market where it is, with values where they are, to pay that right now. But what if that changes? What if that drops off 5%? Would you still pay that much? Because that 5% drop is coming 6 months when you're exiting your deal, right? Mm-hmm. So the first thing I would tighten up on is buy price. The second one is just inventory. In my opinion, there are plenty of investors out there doing volume that don't have the systems and the infrastructure to do what they're doing. Some people have a very tight operation, but many people who have a dozen projects going on right now do not. Mm. So if you can't do a dozen well, you might need to do half a dozen very well. And that'll help in a couple ways. That will make each one of your deals tighter in the event of a correction going on. Plus, I think that people will find that they can squeeze more money out of their deals if they do fewer. And I know that's not what you hear every day. It's always like, oh, I want to buy more. I want to, give more deals. I want to blah, 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 blah. So you can do, 10 deals worse instead of 5 deals well, right? So I think that would help for two things: just business model in general, straight operation, plus being prepared for a change in the market.
So that's interesting. So, and I know this from talking, but and I think we've grown into this as a company, is that, more money per deal. And I don't think it's just more money per deal because it reduces your overhead on the back end and so forth. It's also because it protects you, right? Because it protects you from the fact that, like you said, if I'm making more money per deal, if I'm flipping a house and normally I'm going to make 25 grand, this is the marketplace where you want to say, I'm going to wait till I get that 50 grand house. And yeah, I might miss 2 houses along the way, but in the event, you look at it like a trampoline, right? So the idea being that if the market is going to correct, you're bouncing downwards on a trampoline. You've got to make sure you've got enough spring to get back up. And that $25,000, those springs might be too tight in the event of a correction and pop. And now you got a problem. Your business implodes. At $50,000, though, you've got a lot of give. And maybe what happens is you tighten everything up. Your operations get cleaner. Overhead becomes less. You're a little bit more patient, which is huge. And then, in the event that there's a correction, those $50,000 deals could easily turn into $25,000 profits or less, but you're prepared for it. You don't have a massive amount of overhead, a massive amount of debt. And I'm sure you would attest to this, but over the years, making more money per deal is just an easier way to work, right? Like, it's just a better
work, live. It's smarter. It's a better life. Like, all of it. People get way too obsessed with how many deals they're doing, and it's all right. Here's an exercise that people could do that I beg rehabbers to do.
Okay.
And it almost never happens. I'll see maybe one or two of these ever. And we've had meetings specifically about it. Okay, let's think about it before and after. And we have tools, like we have free tools on hardmoneybankers.com for this kind of thing. You can use a spreadsheet, your accounting software, or whatever. Do a projection before. Say, here's every number in my flip. Your purchase price, your construction costs broken down, your holding costs, finance, resale, all of it, right? And a bottom line number. I project I'm going to make $50,000 on this flip. And then have the discipline to redo that exercise after you sell. Most people will say, okay, it didn't work out. It's great. I don't know if I want to see it. It's like seeing your golf swing on video. I don't know if I actually want to see it. I'm just going to trust that it's like okay enough. And do the real honest after numbers and see what changed. See what changed from your estimate. Look at them side by side. You didn't perform well on this or that, or you held too long. Your price is too high, so your finance costs went up. All that stuff, look at it side by side and see how you can improve your game. See how you can improve your deal by deal game. And I mean, honestly, like we don't want to tell people not to buy properties. Obviously, we have an interest in people buying properties because we get to lend to them. But I think there's a lot of people out there that should do one deal at a time and do it really freaking well and with great margins and good profit and safely. And then you could do two at a time.
That's really interesting you say that. I find personally that when somebody comes to me and says they're flipping 50, 100 houses a year, I'm not really impressed in terms of, but if you said to me, I'm averaging 100 grand a house, I would say there's a substantial operation in place and I would be impressed. Or a guy that let's dumb it down and say the same thing for somebody doing 10 versus 1. I am way more impressed with a guy that takes a $500,000 house and makes 100 grand than I am a guy that does 10 deals and makes 25 each. It is just, you really run a tight ship to be able to do that. You oversaw it with perfection and you're running a serious model. Like, even though it's smaller, and then you can scale, right? You can scale one at a time, much more controllable situation. So I really like that exercise. Actually, we've never, off camera, on camera, we've never talked about that. That's a really good exercise. And you're right. It's just like a golf swing. You don't really want to see it, but the reality is, if you look at it, it's the only way to get better and grow. And otherwise you're just going to be repeating the same crappy golf swing over and over, right? So that's it.
You have to face the music at some point.
Face the music, right?
You take a hard look at those numbers, and still HMB clients around here. We've had a few people do that, and we've had our meetup group once or twice. We had case studies, we would call them, and we would do exactly that. And it made for entertainment, like there's mishaps and different stuff you didn't anticipate, but people really learned a lot. And I encourage anybody out there who's buying and selling properties to do the same, even though it's hard, even though it's a pain, might even be embarrassing. It's a smart thing to do.
There's nothing more embarrassing than losing money, so I'd rather stand in front of a room of 1,000 people and have them knock me down than lose money. So take it for what it is, because you're going to learn from it. So guys, everybody watching, Chris Haddon, there's more than a decade worth of watching finance, doing deals, sitting in front of you doing this interview. So Chris, I really appreciate your time, and I'm sure everybody else does. You guys know where to reach us. It's IAN, just my first name, at hardmoneybankers.com, or Chris at hardmoneybankers.com, and we'll catch you guys next week.